Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Our panelists don't need much of an introduction, but I'll provide a brief one anyways. We'll start with Wade Dobbin, who's partner at Panattoni Development Canada. And Wade's real estate career spans back to the mid-1980s. He spent 20 years as top industrial agent at Cushman & Wakefield in Royal Page at the time. And he's the founding partner of Panattoni Development Canada in 2005. Wade and Panattoni have developed over 15 million square feet of industrial properties over the years. And Wade is also the owner of Dobbin Estate Winery, which is a very excellent wine that I had the pleasure of enjoying and had a very nice write-up in the Wines in Niagara recently. So Wade Dobbin, thank you for joining us. Matt Johnson, real estate career spans back to the late 1990s. He spent 6 years with Summit REIT and ING Real Estate. When KingSett acquired ING and Summit portfolio in 2010, Matt transferred over, and he's had an illustrious career at KingSett. Just for reference, that ING transaction was $2 billion in 2010 for 400 industrial properties totaling 32 million square feet. The going-in yield was 7.8, and the average price per square foot was $62.50. So we've come a long way. I think that deal's worked out well. And Matt is active in the growth fund for KingSett, which fund A raised over $7 billion in capital. So massive institution in our opinion. And lastly, Kevin Leon, whose real estate career spans back to the late 1980s. He began as an investment sales specialist at CBRE, quickly ascending to vice president, spent 10 years there. After CBRE, he moved on to CIBC World Markets, where he was the managing director of real estate banking group for 10 years. And then in 2010, Kevin founded Crestpoint, which has grown since 2010 to over $7 billion of assets under management.
10 now.
It's 10, okay. The website needs the update. Which includes office, industrial, retail, and multifamily. And Crestpoint's currently involved in the development of over 6 million square feet of industrial development. So we do have an absolutely fantastic panel today, and want to thank you all, gentlemen, for joining us. So the topic is the state of the industrial market, and we're going to focus on 4 very important pillars of our market. What is happening with market rents, what is happening with stabilized cap rates, land values and development, and then challenges and opportunities moving forward. This is the GTA industrial market going back to 2009, and we've just plotted availability rate in dark blue and weighted average asking net rent in light blue. And you can see the different growth rates of rents over that time. I think what's particularly interesting to all of us, and the question for the future, we've seen growth rates of 15% year over year for a period of 4 years, starting in 2016, and then over 30% year over year beginning in Q2 2021. Big question is, what will growth rates be moving forward? But maybe before we go there, I'll ask one of the panelists, maybe start with you, Matt. Do you think, apart from low availability, have there been any major drivers to cause this growth in rents beginning in 2016 or 2021?
Thanks, Vic. Thanks for having me here as well. And I also appreciate Colliers as the one group that knows how to do it right, and they open the bar before we start speaking, so everyone's nicely lubricated, so appreciate that. Other drivers, I mean, obviously rent is a function of demand and supply. Supply has been constrained, obviously. The regulations that we have in the Canadian context do keep a tight lid on the amount of new supply that comes to market, and demand has been growing. Obviously, the e-commerce story is one that's relatively new. The pandemic pushed that forward. The switch away from retail done at a bricks and sticks level, more on the platform, e-commerce platform is continuing that. Just in case inventories, all these things are all leading to increased demand, and the supply does remain constrained. So that's just the resultant is going to be increased rents. And I think I'd only add to that, as well is that Toronto's always been a lagger when it comes to pushing rents across the country, and that really changed a number of years ago with the acquisition of Pure by Blackstone and a real push to actually push rents up, and everyone's went, okay, this works, so let's follow along, and here we are.
So after periods of growth of 15%, 30% year over year, I think that the big question is, where are we heading? And as part of the invite to this event, we did send out a survey with these questions. I'm going to put the panelists on the spot and have you answer first, and then we'll reveal the results. But over the next 24 months, do you see average industrial rents in the GTA growing by less than 2%, 2 to 4%, 4 to 8, 8 to 12, 12 to 15, or more than 15% year over year? We'll start with you, Kevin.
I may be a bit of a contrarian here, even though we have a lot of industrial. I would actually pick B, 2 to 4%. That's on an annual basis.
Yeah, we're underwriting 2 to 4. I think what we'll find is we surprise the upside. I think that the constraints are still, real, and we're going to continue to see it be a landlord's market. So I'm gonna say C, 4.1 to 8.
Oh, I got that. All right. No, I would say I think it's going to be sort of mid to high single digits. So I suppose C or D. So I'll take C.
Oh. So, I guess Matt and Wade are aligned with the survey, but we'll see who's right. So most respondents came back with 54% seeing rental rate growth of 4 to 8% per year over the next 2 years.
In fairness, if you had said 3 years ago, I'm going to underwrite 15% yearly increases, you would have been laughed out of an investment committee, and yet we saw that. So I think people are now realizing, okay, rents can move by that much, but I don't think many groups would be underwriting that kind of growth. They might, that's what you're hoping for, but that's not what you're going to put in your model. But.
Right. So I guess, looking at these results, and they somewhat align apart from Kevin, are we entering an affordability issue? So the average rent in the GTA right now is around $18 per square foot. Vancouver's at 22, so it is around 23% higher, but even 4%, 8% growth rates, how long can that continue? Are you feeling pushback from your tenants with the rising rents?
Yeah, we are getting pushback, but we've been getting pushback for the last 4 years. So none of the tenants like the higher rates, and that doesn't surprise anybody. And we're still relatively, we compare ourselves a lot to the American markets when we go to our investment committees. It's an American company. And we're still well below 5 or 6 or 7 of the major markets there. So until we start hitting the Inland Empire in California or some of the other markets in New York, so I think we still have a bit of room to go because they're paying it elsewhere. And it's the same companies here in Canada as it is in California and New York and Chicago. So I think we have exactly the same as what's happening in Vancouver. Maybe a 20% more, and then they are going to. But they are pushing back, and they've been pushing back for a few years now.
Pushback's been there from the beginning. I think the real bifurcation is going to come from the Class A and then everything else. The bigger surprise to me is not really where a Class A building's gone to this quickly and where it could potentially go. It's how much it's dragged everything else up with it. And I think that it's become a commodity to the point where everyone says, well, it's an industrial building, and you go, well, what's the clear right? Well, it doesn't matter. Well, it does matter, and it matters to pallet positions, it matters to cubic feet. So I think what you're going to see is people wake up to the fact that, something that's a little more, obviously higher clear height, better shipping, all those types of things that we all talk about, is going to matter more and more. And I think that for the good quality industrial that's in really good locations, some of the urban infill stuff that's happening, you're going to see, we haven't seen the top of it. And I don't think you'll get as much pushback for that because there is a value proposition there for the users at the end of the day that they can make better use of the space, automation, et cetera, in better space. It's the stuff that's kind of second generation, third generation that I think you're going to be a little more surprised at how much we're pushed up against how far we can go on those rates.
Yeah, and I think that ties into a question I had here. So the market average is 18. You look at brand new space, 20, 21, 22. That $2 to $3, $4 delta does not seem sufficient. I think you would align with that. Are there other subsectors that you see either outperforming or underperforming? And that can be phrased in terms of large bay versus small bay or different geographies within the GTA. Any insight as to your thoughts about what might outperform or underperform within industrial?
Sorry, just to finish that last point on rents, and then I'll answer your question. As much as we have more industrial in our portfolio than anything else, and I love the sector, but it's not immune to the credit and capital markets. So these users do have balance sheets, and so one of the reasons I'm a little more cautious on rent is because the economy is having, the economy is volatile. There's lots of things going on right now. So, is there sticker shock? Absolutely, but don't be, as the panelists have said, they'll pay if they can pay it. The question is, there's going to be some other constraints. That's why I'm a little more cautious than the rest. As far as the sector is concerned, we've made a good living out of the east end of GTA. We've got lots of stuff in the west end. Most of our existing assets are in the west end. And it's remarkable how far the East GTA has come as far as rents. And as we I get a little more normal, I think you just have to be cautious that, the general market may slow down, but we were fortunate, one of our tenants wasn't even looking in the East End, and then ended up in the East End. So I think those traditional sectors, the Mississauga, the Bramptons, they're always going to have the most demand. Labor's a big factor. But probably where I would be, East GTA is still part of GTA. I guess my question is, what happens to, as we get a little farther out, the Brantfords, the Hamiltons, the Cambridges, do you see a little bit of a slowdown there? And so I think as the market stabilizes, you want to be in the more traditional locations. That's not to say you got the right cost base. I think those other markets will do really well. But, you're going to want to be in a little more of those traditional locations.
So we're bullish on rental rate growth, our team at Colliers. We did receive an interesting statistic at our industrial sales meeting this morning that I just thought I'd share with the group. So an analysis of listings comparing July 2022 to May 2023. In July 2022, there were 47 industrial lease listings in the GTA. As of May 2023, that number is now 292. So it's a five-fold increase, 521%. And the amount of space available has increased from about 5 million square feet in July 2022 to 13.5 million square feet, which is about 170% increase. Specifically within a subgroup, the listings between 15,000 square feet and 50,000 square feet is where we've seen the most increase in number of listings. So that number has gone from 28 listings in July 2022 to 222 listings as of May. So that's almost a 700% increase. So that could be an area of bifurcation as well, the smaller versus large bay. Keep an eye on that. I thought that was interesting. I just learned it today. So the other big thing that's changed in our market is the annual escalators in leases. It used to be historically around 2%. It's been increasing. I'll ask the same questions to the panelists. What are you achieving within your portfolio? Under 2%, between 2 and 3, 3 to 4, 4 to 5, or more than 5?
We're getting 4%. That's we're kind of locked in on that. We know some of our competitors are insisting on it as well, and we're getting it.
Yeah, we're getting the same. We actually just did a deal in Montreal with 5% yearly escalators. So that's, that just shows how much that market's moved as well. You said it used to be 2%. I remember back in the day when it was like 25 cents every 5 years, and then you were over market by the time it expired, and you had to PV the above market rent. I feel like with these kinds of increases that we've baked in, it's possible that we're having to get the old PV calculator back out for the expiry, but we'll see.
I'm not a consensus guy, but I have to be on this one. So we're getting 4% too generally, and we're getting some cases a little higher. But I am starting to see one thing come in the market, which is if you're in a long-term lease, you're starting to see people ask for a lower escalator in the back 5, the back 10. So that's something, we haven't done that yet, but we're starting to see that.
And the results of the survey are very similar with most, I guess, straddling that 4% annual escalations. I guess I'll ask the question, I think this leads to the next question, and maybe holding Kevin aside, but if the consensus is that market rents are going to increase by closer to 7-8% or 6-8%, but the steps being achieved are around 4, why do leases greater than 3 years? Why do longer term leases now?
Well, I mean, a lot of groups are doing shorter term leases and wouldn't do the long term, and I think that thinking has changed. I mean, we do have to remember we still operate within a capital market where you've got to figure out a way to fill in your capital stack, and having longer term leases allows you to do longer term debt, which is right now cheaper with the inverted yield curve. So I mean, there's a lot of reasons to de-risk and take that side of it off the table. I think what we have forgotten, a lot of people have forgotten, is that it is still a risky asset class, that there is still the possibility of groups going bankrupt, giving back space. Locking in longer term with a good quality covenant is something that I think will come back into vogue and has fallen out of vogue recently. So I think you'll see more longer term coming up. And to Kevin's point, I think you're going to start to see some pushback. We're talking about right now about what the percentage increases are going to be, but 3-4 years from now, if we start to see that drop down to 1-2%, I think you'll be happy to have those 4s and 5s baked in.
Kevin, you had a bit of a
No, I mean,
reaction
I'm
to
not.
that question.
This because I've already said my position. I'm happy to lock in 4%.
Yeah.
Right. So
I guess this is a question from somebody who entered the industry in the 2000s versus some panelists that have seen a couple market cycles, right?
Yeah, exactly. And to Matt's point, we do have to finance our assets, and things could change. If we all knew for sure the rents were going to go up by 7 or 8%, you're absolutely right. We should all do it, but we all hope they go up by that much. But
It was good play 5 years ago. I don't know if it's a good play right now.
So shifting to the investment side of things, this looks at the GTA industrial investment market, so no vacant sales, just tenanted assets, going back to 2007 on the left. You can see the dollar volume just really increased from what used to be around $1 billion market to 3.5, over 4 billion over the past few years. And obviously this compression in cap rates. And we currently, although cap rates have moved up this year, we see a spread of around 200 basis points between the 5-year Government of Canada bond and cap rates. Historically, that spread's been about 414, so we are still in a very tight spread environment. Now, what's a bit deceiving about this volume figure is when you look at the square footage that have traded in every year, 2021 and 2022 were very strong years, but not surpassing some previous peaks, even going back to 2013. So what has changed? Rents have gone up. Average price per square foot has gone up tremendously from the KingSett ING sales in the 60s to up to over 300 a foot. So I think that's important backdrop on the investment market, and probably leading to the most important question: where are stabilized cap rates for Class A industrial in the GTA today?
I apologize, I missed our pre-call. What are we classifying as stabilized cap rates? Is that something with
10-year
market,
term.
10-year term with a new market rent deal?
Yes. Do you want to think about it? Or,
No. I'm happy. No. I just wanted to clarify. Then, I mean, as everybody realizes, you cannot get financing for less than 5% today. So, I'm going to go on a limb right now. They should be G.
G is more than 5.25.
Yeah. Well, sorry. I'll say 5.25. Actually, my number's 5.25, so I'll say half.
F.
I think they should be as well. I think we're finding the market's resilient in finding people who will continue to buy with negative leverage. Once again, going back to the built-in growth in the rents, people are growing into a yield that they're comfortable with. They're starting off someplace that they're not so comfortable. I think you're probably still in E territory, 475 to 5. I would say it's going to start with a 4, but it's going to be close to 5.
I'd say D or E.
You know he's a seller.
We actually just sold a building. They went from yesterday in Hamilton, 1650 rents, brand new building. We got 5% cap rate on it, but it has the 4% bumps.
Well,
That's what's skating everything on site, right? So that's why I'm going sort of 4.5 to 4.75 for something here in the GTA. And those assets are hard to come by. So there's a scarcity of the asset, and for sure there's the financing problem. But some of the guys are just going to find their way clear to say, well, I can't own a brand new asset that has all these fabulous attributes and 4% bumps for 15 years. So and I would ask myself, what would I pay for it? And we were considering buying it because it was part of
assets.
Yeah, and so no, but it's hard to get those assets, right? And eventually you're glad you own them, right? I mean, everything that's sold over the last 20 years, you wish you had bought, because the fundamentals of industrial are really, really strong. And people are seeing past the credit markets and past what's going on. Whether they're right or not, who knows?
I mean, just to be clear, we're closing a sale next week. We sold the building at 3.5, but the rents are considerably below market with a weighted average lease term of 4 years. So it's in the threes, right? So, I mean, that's why I asked the question, is it because there's still low cap rates in the industrial space, but it's typically based on the fact that they're catching up to market.
Yeah, and this is stabilized at market with term. And again, you're in line with most respondents here, with the most popular answer being in that 4.75 to 5 range, and the second most popular 5 to 5.25. I was going to ask how we justify these types of cap rates when you have the bond rate at around 5-year bond around 3.7, historical spreads of 400 basis points, lending spreads of 170 to 200. You're underwater, but I think you provided some good rationale around scarcity, long-term performance, as a reason to justify that. Is anything else? Like it seems like the spread is still pretty tight.
And Wade's point's a really good one. Like there's a huge difference between going to market with a 4% escalator and a 2% escalator, because there's still deals that are done not too long ago, and we have a couple of them that are 2 or 2.5. And your value is, your cap rate's going to be much higher on those.
I think it also speaks to the fact that the market's been so deep for so long. There's a lot of people who've been left on the sidelines. And now, the bid pool for a Class A, a year ago might have been 15 qualified bidders, and now it's 6, but there's still 6 qualified bidders. And you end up with kind of the same, resultant at the end of the day. It's just the groups that have been priced out are now, some of them are starting to get an opportunity. You see a lot more privates, not when you get into the really big deals, but sort of the mid-sized deals. You're seeing a lot of private groups who I think have a really long-term view and say, I won't be unhappy owning this in 10 years, really stretching and just, holding your nose on the low cap rate to begin with and growing into it.
Which I think segues to the next question, which is very much tied to cap rates as well, around financing. Where do you anticipate financing rates will be 1 year from now? Will they be lower, more or less the same, higher?
What are we, 5-year? Talking about 5-year money or 5-year money? I would pick B.
I'm going to say higher. I think not just the overnight rate going up, but I think we'll start to see spreads also increase, because there's more pressure in the lending market.
I really don't know, so I'll pick A. I always hate guessing at where financing rates are, because a year from now could be, if we go into a big recession and they cut rates. So I'm probably more or less the same as B, my guess.
I was saying that now, you've seen the survey results.
Wade looked at them before too. You want a sneak peek, so.
I mean, you think about the last interest rate increase. Everybody thought for sure they were pausing for the rest of the year. And we'll see a cut before we see a raise, and they raised 25. And now the consensus is that there'll be another 25 in July, maybe even 50. So I think we've got a bit more on this
But
story.
don't you think if they actually, we're talking about 5-year money, which means, and I know some people are buying all cash, and I agree with your comment, smaller, there's still people, but as you get up mid and higher, like from a dollar standpoint, if rates go up, it's not going to help the cap rate side of this business.
No, it won't.
Yeah,
No, it
so-
won't. No, I just think that the yield curve could also flatten a little bit more. I think you could see long-term 5-year bonds going up and being a little more in line with historic levels as opposed to being inverted. So that could have a big impact as well.
Do you think there's a type of borrower that's been most impacted by the change in rates? Is it the value add interest only buyer? Is it developers, construction financing, or is it the conventional investor that would put 5-year term financing, or is it universal? Is it, within your portfolio, what's the impression there?
Well, construction financing is a lot higher than it was a few years ago. And for sure, for instance, the US guys got hit a lot harder than we have, but they're having a lot more trouble getting financing than we are here in Canada, which is very unusual. In fact, in my career, I can't remember that ever happening. So construction financing is tough right now.
Yeah, and if you're floating, I mean, you're getting killed right now. It's very expensive. So, locking in, if that's in the strategy, is obviously makes a lot of sense. But I think a lot of people are underwater with respect to cash flow because BAs have moved up and it's not cheap to float.
I mean, it's absolutely all of the above. Now, some sectors, I think, as Wade said, is more affected than others. But even if you're an all-cash buyer, everything is relative. People don't invest in real estate and with blinders on. They invest in the fashion of everything in the investment horizon. So and so whether it's equities or bonds or other asset classes, most of the capital is comparing has opportunistic has an opportunistic cost to it. So bottom line is, as interest rates increase, your cost of capital is more expensive, even if you're buying all cash. So it's going to affect the market.
I think what is going to happen though is some of the financing is definitely going to affect how much is built. So I think a lot of projects are going to get shelved, or even tenants that want to do a build to suit, they get sticker shock and say, well, we'll postpone it, etc. But on the spec projects, I think there'll be fewer of them. And even though there was a lot of spec though over the last year, this is probably our best year ever. Will be 2023. I don't see 2024 or everybody going nuts to get an empty building out, given the uncertainty on cap rates and rental rates and financing. So
I do think that's right.
You're jumping ahead to the development section, so
sorry.
we will cover that. So we've seen a massive run up in financing. It's impacted cap rates. It's impacted values. What is your sentiment on how much industrial values have changed over the past 18 months? So A, 20% decrease or greater, B, 10 to 20%, C, 0 to 10, or has there been an increase in values?
Yeah, I mean, it's not, I mean, you can't paint it all with the same brush. 18 months ago is kind of what I would see as being maybe the peak, where the Everlast portfolio, that's about 18 months ago, the Northleaf portfolio, we've seen definitely come down from there. I'm going to go with C.
I agree that it's hard to just pinpoint the whole industrial segment into one of those categories, but if I had to pick one, I would pick C as well.
It's interesting because this isn't the first time we went through something like this. Generally speaking, the prices are sticky. They come down a lot slower than they go up. So I would probably say C as well.
And one other comment that's interesting, it's the only asset class that I know for the most part where a shorter WALT means you can get more money for it, right? So that's kind of reverse in what you're thinking.
Yeah, and I guess the responses from the survey are similar, kind of straddling that 10% decrease, a modest decrease. I think a lot of that's been offset by rising rents, right? So we've had rents rising 30% year over year since 2021. We've had cap rates impacted, but if financing rates hold, hopefully cap rates stabilize. So I think the question that I have is, over the next 18 months, is this a good time to be buying, or would you be preaching patience and believe there's better opportunities ahead? Start with Wade, if you want to.
Well, I get the fundamentals in industrial real estate have never been better. Never been better. We've got low vacancy rates. I would say it's very dependent on the deal. I mean, it depends on the. But if you're going to get a really good high class piece of property, you know, I bought my first industrial piece building in 1993, and I'm really glad I bought it. And you know, I remember agonizing over whether we were going to pay $27 a square foot or $24 a square foot. And I mean, does it really matter now? So I think it is a good time to buy it if you can get decent financing, if you can make it all work. There's and the prices have come down. So we're seriously looking. And now you've got a selection. You know, trying to buy something 2 years ago was almost impossible. I think I remember we had some investors in town who said, well, we can take you to look at every single building that's available because there's only 4 over 100,000 square feet or whatever. So I think it will. I think it might get better. I mean, frankly, it depends on which way interest rates go and what kind of financing is available.
Better for a buyer.
Better for the buyer, yeah. But not a whole lot. I mean, I don't think it's going to get a whole lot better. But I could be wrong.
It's always a good time to buy industrial real estate. I mean, I got some for sale, so we can talk. But listen, you're never going to time the market perfectly. You got to look at it based on what you're trying to achieve, what your strategy is, what your long-term, short-term view is, and just try to make the best acquisition you can based on where you are at that time. So, time of the market, you'll never do it right. So, I'd say if you're in the market for industrial real estate, just figure out what your assumptions are and stick to it, and chances are you'll look back and go, I can't believe I was agonizing over that because it's now $500 a foot, whatever it is.
Yeah, I do think it's deal dependent. I mean, there's an analogy they use with the kind of the equity markets. Is the market going up or down? Neutral. It's a stock picker's market, and I think it's somewhat the same way in the industrial space right now. I think the attitude for most is probably, at least from our perspective, is we are still looking a lot. Are we as aggressive as we were 12 months ago? Probably not. But we still love the space long term. We think there's going to be opportunities where maybe if you looked at 3 or 4 opportunities where you said, I'm going to bid on 2 of them, maybe not only bidding on 1 of them. To kind of pull yourself back and to say this is not the right time, it's a risky proposition to do that.
We covered a bit of this, but I think it ties in as well. So we've had rising rates. Have your return requirements for GTA Industrial changed over the past 18 months?
Yeah, answer is no. We don't change our requirements, as the market moves. We sort of stick to what we're looking for. We try to find things that fit that return profile.
I mean, overall, no, but your unlevered returns have, because you don't get the benefit of leverage as much.
For sure.
Yeah, so from that perspective, yeah.
Yeah, and I guess surprisingly, around 65% of respondents said they had increased their return, but it's good to hear that it hasn't for your firms.
That's not saying we're still achieving what we had underwritten, but we're still underwriting the same
But
return.
would you say though, what the biggest change is you're more conservative in your assumptions today?
Absolutely.
Than you were.
Yeah, absolutely.
Yeah, so it's not just about returns. Like I have this argument with our board sometimes. I'm like, well, we should get a way bigger return. But what if my assumptions are way more conservative today to get us to the same place? Right?
Yeah, exactly. We're gonna be more selective. It never makes sense to say I'm taking myself out of the market. I'm not going to bid on something. I mean, there's obviously a clearing price for everybody at some point. So put your hat in the ring and see if it's if the vendor has gotten to where it makes sense for your assumptions.
Are you more confident in your rent assumptions in underwriting or your terminal cap rate assumptions?
Rent by a long shot.
Rent by a long shot. I'm never confident in the terminal cap rate, to be frank.
I'm curious.
I don't know, you could argue you're more confident in your terminal cap rate today because you're not using the 4 So I don't know, I'd say I'm almost more confident in my terminal cap. Not to say I'm not confident in the rents,
No.
but I'm saying,
But I mean, the difference in your returns if you're using a 6 exit cap versus a 6.5 is pretty dramatic. I don't know if 6 or 6.5 is right. Which one's right? Maybe it's 7.
well,
Maybe it's 5.5.
you're really pricing it up. What do you think the long-term bonds are going to be? So.
Yep, for sure.
I guess, Matt, you have some concerns around financing and cap rates and.
Well, not necessarily. I just, we don't control what the bond market does and what the interest rate environment does.
KingSett controlled
We don't tell people we control what the bond market does. So I mean, it's that one thing. Not that you control, the market rent either, but you're actually one of the parties at the table. You're not really a part of the table when it comes to the interest rate. I mean, you're kind of price taker.
Fair. So shifting to development, land values have seen a similar run up to rents. So land values in dark blue, rents in light blue, and they've both been growing at very strong rates year over year, which has had an impact on the development model. So this looks at a development model for a building in the Brampton submarket back in 2007, building for $80 a square foot and solving for 7.5 yield, target rent $586. Well, the market's moved quite a bit. We're currently probably replacement cost somewhere around $375 a foot. And with the move in terminal caps, you now need a rent probably in the 24 range at this land value, which is a premium to the market average of $6.30. It's higher than it's ever been. What's your sentiment around development at the moment? Something you're looking to do more of, or?
Well, also, I mean, luckily we don't have any land at 3.5 million. So I don't, if we were all buying land at 3.5 million, I don't think we get, I'll guarantee we wouldn't go ahead. So I think land prices have peaked and are probably coming down faster than anything else, which makes sense because it has less utility than a building that's up that you can rent right away, and I think almost everybody would agree with that. We're still, I mean, it still is only 1.2% vacant market. So I mean, that's pretty amazing. I've been doing this for a long time, and that's really, really low. So we're still positive in it, and it's also getting a bill, getting site plan approval on a building permit is very, very difficult. So we haven't, I think we're going to, instead of about 2 years ago, anything we could have got a building permit on, it was go, pedal to the metal. Now I think, we're going to lease something up, build another, or feel like you're going to lease something up, build another one. So I guess my point is land prices are probably going to come down a little bit. Once you get over $3 million an acre, it's really tough to make sense of it. And but under the $3 million, if you can be building, $250, $275, yeah, you're probably going to go because you're a lot more confident now than you were 2 years ago that you can get $18, $20, $21. I mean, we're getting $21 for new stuff. So when we were performing it a few years ago, rents were 14, and you had to say that you could get 18. So I don't think anybody would get. I don't think you'll get many people going ahead saying that they're going to get $24, but people will continue to build. It's tough to build it.
Maybe pass or go ahead.
Yeah, so we don't do a lot of development, but yeah, I would agree with what Wade's saying. Like the land value is the real one that sticks out there to me, and I think I agree. Land prices have to come down, or they've peaked, or they're coming down. But there's really no trades to support that. And will they come? Probably. I think we're going to see it settle down a little bit. The $24, I mean, for a brand new building in a great location is probably not that difficult to stomach. I think at some point, if you're building best in class, like that's kind of where it's going. But the land price, I think, is the one that really sticks out, and the terminal cap rate at 5%, like that moves to 5.25, 5.5. It really puts you underwater in a hurry.
Yeah, I don't know how you can. Yeah, it's hard to justify a terminal cap rate of 5% with body type today. I do think
the cost of putting land aside, on the plan in a second. If we do the bigger project, those costs are probably a little lower than what's on the screen there. So maybe your costs are, you see a little bit of a pullback on construction costs. I think that, you asked, are you more confident in terminal cap rates or in rental rates? And I think we all kind of answered, I'm pretty confident, or it's like both. I think the part that, maybe somebody here is confident. Where are land values? Because every group like yourself I talk to, you're not sure, right? And maybe you can give us some insight because, land values apparently haven't gone down that much, but that's because not a lot is traded. So
Yeah, I mean, the price of anything is what someone's able to or willing to sell it for, right? And I think that's the challenge with land is a lot of it has been held for a long time. And typically, I think on paper, land values have come down, but does that mean you're going to see sellers at these lower prices? Historically, in 09, we saw the land market really cool and not many transactions, which is something that perhaps we see again, not a lot of comps. But I think it's hard to argue that land values have gone up given what's happened with cap rates.
yeah, and it hurts to borrow. Unless you guys something different, we got to borrow on floating rate with construction. So we're doing some developments, and 7% is a lot more painful than 4%. So that's not helping either. And fact is, municipalities, they say they want to bring on things quickly, but I'll give Alberta some kudos here. The only place I see getting a permit quickly is Alberta. So.
There's been a large emphasis on last mile, last touch facilities. There's a lot of active projects in Etobicoke. What's your thoughts on that concept? To date, they're performing well, but haven't really outperformed in terms of lease or lease up time. What's your view on last mile, last touch? Maybe start with Wade.
Well, actually, I talked to we have a business partner in the U.S. who does all the Amazon deals. We've done 100 Amazon deals, say, in the last 5 years or 3 years. And his, he told me three interesting things. First of all, they're now talking about first mile. So they get the loads in, and then before they go to those big robotic centers, where the robots pick everything, they do the load before it goes to there. So that was interesting. He also said, though, that on the last mile stuff, Amazon they're not getting rid of them because they're so well located. Even though it's not working out quite as well as they thought, they're going through some growing pains on that. So I think it's a little bit, not in its infancy, but they're trying to figure it out. But they're not getting rid of those. So that's a good sign. In this market, I think it's just a better time if you've got, something in Etobicoke, it's going to lease once it's off. All of us perform 6 months to a year vacant. There's not a lot of vacant buildings, brand new buildings out there that I'm aware of. So I think what people are doing is they are waiting. Like the tenants are going to wait to make sure that you've got power to the building, you got your lights in, et cetera, because we have a building that somebody moved into and they're still operating on a 200 amp panel for a 400,000 square foot building. It's a bit of a problem. So I'm not too worried about that. I think those things are going to lease up within 6 months of being built.
Yeah. I don't know if I agree they'll lease up. I just don't know if they'll lease up because they're last mile necessarily. I think that maybe the whole last mile idea in the Toronto context might be a little bit overblown. The amount of time it takes to get a product, if you're trying to get something to somebody in 2 hours, I'd be curious to know how much of that is due to wheel time versus how much is due to in the warehouse itself, trying to get it into a box and out the door. And maybe it's more automation that's more important. You could build a highly automated facility out in Whitby and be more of a last mile than a less automated facility in Etobicoke and be able to actually get product out. I don't know the answer to that, but I just think that there's a lot more to it that we as real estate people probably, we think about location obviously, and location's going to get something leased up quickly if it's in a great location for a myriad of reasons because it's in a great location. It's not necessarily that last mile piece that's really driving. that story. I don't know.
Yeah, I think they are still trying to figure it out. We don't have any developments down in South Etobicoke, but we have a couple of buildings, and one, in Canada, I was cautious a little bit. We had a vacancy come up, and I said, well, the new buildings were only asking, I think they're asking about 20. I don't know if that's right or not, but I think that's what they're asking in South Etobicoke. And I was a little worried about, we were asking 1850 for an older building. Very functional. I mean, I said, that's spread wide. Now, we haven't leased it pretty quickly, but it was here and there. To your point, I think because they haven't figured it out, they're not prepared to jump on it right away, really. So I think this time will tell and see how successful they're going to be. One other comment I would make is all this new development going on in GTA, for the most part, right across the country, I would say it's mostly large bay, right? There's mid bay and large bay. And I don't know, is there a market for smaller bay and last mile? Is there a market for small bay industrial at all? Because it's so expensive to build. So I think that's another fascinating thing in our industry. I don't know if you're building any small bay.
No, we can't make it work. Can't make the numbers work. But some people have done well. They built the industrial condos.
The condos
condos for $600.
Yeah, the condos.
I mean, that's. I think that's very similar to sort of residential real estate, where they build the condos and somebody can buy a 10,000 square foot and lease it on himself, and he wants to be in industrial real estate, but he can get a 0% return for 5 years. I don't think we're going to see small bay very often. It's just you just can't make the numbers work.
Which is why you're selling them, right?
Yeah, and there's good buyer depth and there's good rental rate growth. I think this kind of comes back to the issue of the GTA market not having a lot of bifurcation or range of rents. Everything's kind of pretty close to that $18 average. And obviously with small bay, you're going to have much higher construction costs, so you're going to need a rent of 25, 26 or higher. Nobody's done it to either prove or disprove that thesis. I don't know. But I don't see that changing. I don't see anyone developing small bay outside of condos.
I mean, think about it. If it's $600 for a condo for small bay, if you're using a 5 cap, that's a $30 rent, right? I mean, intuitively, it seems like it should work. I don't think anybody's done it because the condo proposition is enticing. I think if somebody goes on a limb and actually builds some small mid bay in a good GTA location, I think they'd be surprised by the absorption, the speed of the absorption, and the lease rates they'll achieve.
And the exit's there on the condo. You're getting 600 a foot. You're not getting 600 a foot on IPP, even at today's rents.
No.
So it'll be interesting.
But the other thing is, I mean, you'd rather do one 200,000 square foot lease than 10, 20,000 square foot leases, and so nobody's geared for that anymore. And we've looked at it several times.
The other major trend that's emerged over the past 2 years, 18 months is ESG and zero carbon. Is that factoring into your developments? I guess start with Kevin and move over.
It has to, right? I mean, it's still a little more prevalent, I find, on the office side, but the industrial side is coming, especially on the new builds. And if you're not kind of gearing your building to satisfy tenants and at least have the ability to add solar panels or make it carbon neutral, you're probably just doing yourself a disservice. So it's 100%, and sure, it's a little bit more expensive, but on a relative basis, I think it's table stakes. We have to.
Wait, I agree completely.
Do you think there's a rent premium from tenants for those?
No.
Here's what I would say. There's 3 tenants looking in your building. One of them may not look because it's not carbon neutral or carbon, and so then you only got competition between 2. So they're not paying you a premium, but you're going to get less tenants who want to go there. So in effect, you might be getting a rent premium just by creating more competition.
And you're justifying the added costs through cap rate compression or to bring in to cater to that tenant that wouldn't look at it otherwise?
Well, I think you're justifying it because you want to enhance your property to create the best, most attractive tenants. And yeah, I think there's cap rate compression. No, but there could be the opposite. If you don't have that,
could have a cap rate expansion.
Yeah, I think it's about future proofing. I think it's something that will be required at some point, and whether it be through financing, that there'll be situations where if you're not meeting certain scores based on ESG requirements, you might have a harder time getting financing. I think to Kevin's point, the user pool grows. So I think there'll be some tenants who simply will not look at a building if it doesn't have certain levels of green standard. To not at least plan for that and rough that in or have that ready to go, I think is short-sighted. You kind of sort of the cost of doing business right now, whether or not you do get a premium or not.
So the last question on the survey was a little bit more broad, asking respondents to rank from 1 to 5 what they see as being the least challenging and most challenging elements in the near future. So pricing, buyer versus seller expectations, 50% of respondents rank this as a challenge, giving a ranking of 4 and 5, although 25% thought it wasn't a challenge. Availability, cost of debt, 60% of respondents rank this as a major issue. Availability, quality of offerings, actually 75% reference that as an issue between 3 and 5, and that's been something historically. There hasn't been enough supply of investment offerings, especially high quality. Sourcing equity, this was a little bit split, so 50% of respondents indicated that it was an issue, whereas 25% it wasn't. Economic outlook, this was a little bit surprising. 80% gave an answer of 2 to 3, meaning that it's not a major concern for them. And then meeting environmental standards wasn't a major challenge for the survey respondents. Is there anything here that you find surprising, that differs from your viewpoint on the market?
I mean, I agree with you, number 4.
100%, because if we go into a recession and like everyone's talking about, and I'll use office as an example. Everyone's talking about work from home. That's why the office market is tough. And first of all, if you've been around for a while, you've seen this office cycle before, long before there was work from home. It's a simple imbalance between supply and demand. Now we don't have the supply problem yet, but what people don't talk about is there's a big demand pullback, and we saw it firsthand in our portfolio, and others have seen. Whereas tenants think they're going to need X amount of space, they make decisions on basically they make these decisions based on economic growth, and they base a decision on their share price, right? And so all this stuff, we saw 2 deals get lease signed and then basically kibosh because the board turned it down. Even though the TI. Our business is totally tied to the economic outlook, and the hardest thing to predict in our business is demand. Supply is not as hard because you could have some people may not go, but you get a sense of where the supply is. So to me, that's surprising that people are not worried about that outlook, because that's a large component of where demand's coming from.
Yeah, I would echo that. I think it's clear that the Bank of Canada has a demand destruction policy right now by increasing interest rates, and they're trying to create a demand recession. And if you're not focused on that and planning for that, I think you're going to be caught off guard. So I think that should be much higher on people's list.
Wait.
I agree. We've had some pretty good times with 15 straight years, so we're kind of due for a big breaking. And as Matt said, demand destruction. That's what we're hearing it for right now. So it's just how bad is it going to be? Is it going to be really, really bad? And they don't know. I mean, they don't know. So we're going to find out over the next sort of 12 to 18 months to see where it ends up. But what we also don't know is if then they'll go immediately and start cutting interest rates again and pumping money into the system, which is the easiest thing for politicians and those folks to do. So it's going to be a really interesting sort of 12 to 18 months. It looks according to the bond market, that it's going to be a reasonably soft rate. But we've got that wrong before, so we'll find out.
So I guess last question of the day, at least from me, I don't know if the audience will have some questions, but what do you see as the biggest challenge, and what do you see as the biggest opportunity for your companies within the industrial space over the next 18 months? Kevin, pass it to you.
Well, for us, I mean, we have a portfolio right across the country. We've got a good foothold. We've got a great team. We've got a lot of developments on the go. To Wade's point, we're lucky we don't have a cost basis, is much lower than what you're showing as a current development cost. But I think if we can keep the momentum going from our asset management team, our development team, keeping in the marketplace, understanding, being close to our tenants, I think there'll be some opportunities on the buy side. And so that's what we're really gearing up for.
Yeah, I agree with that. I think the challenge is always finding opportunities that fit the return criteria, getting everybody on board, getting everybody singing the same song sheet as far as what we think the underwriting should be. That's always a challenge, but that's kind of what we do for a living, so that's fine. I think the opportunities are well capitalized, got a great team, and we're ready to go. So we're always ready to jump on anything that comes available, and if we like it, we'll go hard at it. So it's a good opportunity.
Well, I guess the last time it was similar to this, was sort of 1989, where cap rates and interest rates where cap rates kind of where they got inverted, and so. But at that time, the demand the supply was huge. Like we had was it 10%, 8% still vacancy?
Over 20 million feet of new development.
Yeah, and that was 1989 on a 500,000 square foot base, 500 million square foot base instead of an 800 million. So we're in much better shape, and I think we're also in better shape. All the the people that are in the business now. Back then, it was a bunch of Everlocks, Ben, a bunch of guys named Ben and Jim and Sam, right? So we're a lot better capitalized. We understand it a lot better. Most of the people made a lot of money over the last 3 or 4 years, so we can weather the storm. So if there is a downturn, I think people will just stop building and we'll wait it out. I think maybe the tenants will get hit a little bit more hard and we'll work through it, but. We see the next couple of years as kind of a normalizing of the market, and there'll be opportunities. So, and everybody's going to have to rebalance a little bit, right? So that's when some more opportunities. So it should be okay.
It's good to hear that everyone's still very bullish on industrial moving forward. So that's the extent of our presentation, but we've got a lot of great real estate minds here in the room. Does anyone have questions or anything we didn't cover that you'd like to ask our panelists? Yes, Anthony.
On the development side, are you seeing construction pricing, lead times, and general trade availability given the market? Any change on the front?
From our point of view, it's been remarkably pricing hasn't come down, but it hasn't gone up. Yeah. Number one. We still were, the last job we bid was in sort of April, so 6 weeks ago. We had a few issues with things like steel, but it's pretty straightforward right now. We've gone through the really tough, bidding where things where we can't get steel for 14 months or something like that. So it's coming back to normalcy, just in time for maybe things slowing down. So I don't think pricing is going to come off much, but I would say maybe we'll get 5% off in the next few months, few years, who knows? But it's almost back to normal. It was crazy for a little while, like a year ago.
Yeah, I would agree with that, generally speaking. I asked my construction guy actually before I came. I could ask one of my development managers is here too, but he said we're starting to see a little crack in pricing, but generally I would agree with what Wade said.
Yes, of course.
Hi, guys, thank you very much for your comments today. I have a question as it related to the financing, which you sort of mentioned throughout. Are you seeing as either sellers or as buyers and the take-back mortgages being given now to sort of preserve proper price up, or comment on that?
Yeah, the short answer is yes. It's really it's a structuring mechanism in order to sort of get to a point where you want to be. If you have, what we're finding, if you're a seller of something with a short WALT, below market rents, which is great, that's what everybody wants because they want to get that increase. Then they go to finance and they find out that they don't have the debt service coverage. So then they come back and say, "Can you fill in the gap for us?" So that's very common right now, for sure. And we're happy to do it, make a deal happen.
Especially on land. I think BTVs are going to be important on land. We had to take back 2 BTVs on land on the sales that we did.
I'm not here to wrap it up.
It seems like you're here to wrap it up. I'm getting the hook.
No, not at all. I just know there's some people probably getting really thirsty, and there's going to be lots of time to ask questions to Victor or myself or the broader team. Max is here and Farabi. Firstly, I just want to thank all of our guests for joining us. This was a very, very fascinating discussion. It's great to be here. And a big call out to our panelists today. A wealth of knowledge, and there was no hold bar. You guys answered the questions, and that's what our business is all about. We keep sharing knowledge, and we all keep getting better. So thank you all for coming. Vic, great job.
Thank you.
All right, let's go have a drink.
Thanks, everyone.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.